Okay, it is 10 o'clock. We're going to get started since we have a lot of information to cover. Welcome to the Tools to Grow and Secure Export Sales webinar put on by the Almond Board of California. Again, a lot of information to get to today, so we'll do some quick housekeeping. Let Keith do some quick intros, and then we'll get to the information. First off, attendees, you are muted. You will be muted while the presentations will be happening. You can ask questions in the chat function above your window right here. If you're not familiar with Teams, you can click on the chat icon, which will open up a window on the side, and you can type in your questions into the chat. I will be monitoring the chat, and we will feed those questions at the end. Hopefully, we have enough time. With that being said, I will kick it over to Keith. Keith, I will keep sharing these slides. You can start the introductions, and Jeff, you can prep to get ready to share your presentation.
All right. Thank you, Taylor, for helping us get this webinar set up. If you want to go to that next slide. Everyone, my name is Keith Schneller. I've been with the Almond Board in the Global Technical and Regulatory Affairs section for the past 3 years, working on market access issues as we try to diversify our almond exports and look at new markets around the globe. Before that, I spent over 20 years with USDA's Foreign Agricultural Service, helping U.S. companies export food and agricultural products around the globe. Since coming to ABC, I was surprised that our exports were not familiar with USDA's GSM 102 Export Credit Guarantee Program. However, after talking with numerous exporters, it seems one of the biggest challenges is for small nut importers in developing countries to obtain or open LCs, which is a requirement of the GSM 102 program. And most business is done via CAD, or cash against documents, which is more risky for both importer and exporter. So one of the goals of this webinar is to introduce our almond handlers, exporters to the GSM 102 program to see if it might become another tool for you to consider in certain markets. And we have some other experts who will be talking about different programs that they're involved in. So today, Jeff Albanese will introduce the nuts and bolts of the program in 15 minutes or less. Then Lisa Dow from CoBank will talk about how her bank helps bulk commodity exporters benefit from the program. Joseph Nutty from Acrisure Trade Risk Group will give you a brief introduction to the Exim Bank programs, and we'll also talk about private sector insurance options. Then James Tiarks from Meridian Group will introduce the risk insurance programs his company has access to, followed by a very detailed presentation by Danielle Austin from Umpqua Bank on the benefit of using LCs. By the way, I attended the AgTC conference a few weeks ago in Tacoma, Washington, and learned about work being done by the Digitalized Container Shipping Association to develop standards for electronic bills of lading, with the goal of implementation by the 9 largest ocean carriers by 2030. So Danielle also sits on an international banking panel that's working on standards to digitalize letters of credit going forward. So we have a lot of things to talk about. Anyway, I wanted to keep my introduction short, and will now turn the floor over to Jeff Albanese to get started talking about the GSM 102 program. Thank you, Jeffrey.
Great. Thank you, Keith, and thank you to the Almond Board for inviting the Foreign Agricultural Service to participate today. My name is Jeff Albanese with the Credit Guarantee Programs at FAS. I'm going to share a presentation here. All right. So yes, within FAS, I work in our credit programs division. We have oversight of 2 programs, our Export Credit Guarantee Program, which we call GSM 102, and also our Facility Guarantee Program, which we call FGP. So we'll go through GSM 102, and then I will briefly touch on FGP at the end. So with GSM 102, we are providing credit guarantees to encourage the financing of U.S. agricultural commodity exports. So this program Specifically, we are mitigating foreign bank non-payment risk. So that's the risk that USDA is taking on, is if there were to be a default or non-payment from a foreign bank on a letter of credit, USDA would step in and pay the holder of our credit guarantee for that missed payment or default. So that's what we're talking about here. It's very similar to an insurance-like product, but it's a credit guarantee. So you could kind of think of it like an insurance-like product. So we are letter of credit driven. Transactions under this program must be made via letter of credit. So that means your buyer must open a letter of credit with one of our approved foreign financial institutions to make payment for those almonds that you are shipping overseas. We are developing country focused, and as part of our program, we offer credit terms or repayment periods up to 18 months. And we will provide a guarantee up to 98% of the value of any transactions. And under this program, only U.S. agricultural exports are available, are allowed under the program. So in any given GSM 102 transaction, we have four market participants: you, the exporter, the U.S. financial institution that takes assignment of the payment guarantee. We have the foreign financial institution that's going to issue the LC on behalf of the importer for payment of those almonds. And we have the importer. So for your customers, the importer, there's no qualification into this program required. They only need to be willing to engage in a GSM 102 transaction and also willing to make payment via a letter of credit. For you, the exporter, there is a qualification application required. It's fairly straightforward and just ensures that your business is in fact a U.S. business and is able to do business with the U.S. government. And so during that process, we also give you access to our online system, which is where you are able to go in and apply for our credit guarantees. I won't get into the requirements of the financial institutions too much during this session, but we do vet the financial institutions participating in our program, especially the foreign financial institutions where USDA is assuming the non-payment risk. And so why would anyone want to engage in one of these transactions? So along the sale, each of the market participants is going to derive some type of benefit from using the program. And so for you, the exporter, because we are mitigating that foreign bank non-payment risk, perhaps it will give you the ability to target some markets with greater risk that you might not have otherwise thought about. It could also help you expand your sales or establish sales in new markets. But one of the big benefits is upon shipment of those goods, you would receive payment from the holder of the payment guarantee, i.e. the U.S. financial institution that's confirming that LC. So you're going to receive that payment up front, and then the U.S. financial institution is going to be collecting from the LC based on that credit period up to 18 months. So those are your benefits. And for your customers, this is not always the case, but it's dependent upon the country, the financial institution, as well as the relationships. But because your customers will be bringing a transaction with delayed repayment terms to the foreign bank, it's possible that they may receive some preferential repayment terms themselves. Not always the case, but does sometimes happen. And so we do charge a fee for this program. So USDA, the only fee that we charge is our guarantee fee, and that is the cost of issuing the payment guarantee to you, the exporter. And so it's a variable fee. It depends on the country, the financial institution, but we base it on country risk, the strength of the approved foreign financial institution, as well as the repayment terms, as mentioned, up to 18 months. So this is generally going to come out to less than 1% of the value of the transaction. And we'll just throw a figure out there of 0.5% or 50 basis points. So that's going to fluctuate, but that gives you an idea of the fee that we're going to charge. And so that's the only fee that USDA will charge. The other costs associated with the program would be the cost of the letter of credit and then any financing costs that are incurred with the U.S. and foreign financial institutions. Each year we make available $5 billion for our credit guarantees. And so what that means is that is $5 billion of risk exposure that USDA is taking on in any given year. And so right now, the past couple of years, we are doing about $3 billion in sales. And so we have plenty of availability for people who would like to use the program. And so, as mentioned, as part of this program, only U.S. commodities are eligible. We do consumer-oriented, intermediate, and bulk products, so almonds are certainly eligible. If it were some type of processed product, we do require 90% U.S. content value, so we would take a look at the ingredient list if it were to be a processed product. But generally, it's 100% U.S. content requirement. And so we make around 130 countries eligible for this program. We divide the region into 3 different regions: Latin America, Asia, and then everything else: Africa, Middle East, Turkey, Caucasus, and Central Asia. And so I mentioned that because any bank approved by USDA within a given region can issue a letter of credit for a transaction in any approved destination within that same region. So that could potentially be, just to throw an example out there, a financial institution in Panama issuing an LC for commodity ultimately destined to Mexico. So there is flexibility under the program there. So I just mentioned that briefly. And so if this program is of interest, to get started, you would register on sam.gov, and that's the U.S. government's, that's their system for registering and ensuring that a business is able to conduct affairs with the U.S. government. There's a qualification application with us that's pretty straightforward. We get you set up with our online system, verify that you are indeed a U.S. company. And then after that, you would just negotiate a sales contract with the buyer. We do require a firm sales contract to be in place to utilize this program. You would then enter the details into our online system. You'd pay us the guarantee fee. We issue you the payment guarantee, and then you could contact one of our participating U.S. financial institutions to take assignment of that payment guarantee. And as mentioned, for your customers, there's no specific qualification required, just that they are willing and able to participate in the transaction and make payment via a letter of credit. And so our facility guarantee program focuses on manufactured goods and U.S. services to improve or establish agriculture-related facilities in emerging markets that are projected to have a downstream benefit for U.S. agriculture. So while our GSM 102 program was focused on agricultural commodities, our FGP program is focused on equipment. So an example of this would be potentially a piece of machinery or equipment that could be placed into a facility to increase shelling capacity, for example, and that increased shelling capacity could result in additional exports of U.S. almonds to whichever country it might be. And so this program functions in a very similar way to GSM 102. It's a letter of credit based program. But under this program, we can offer credit terms of up to 10 years. And so there's a slight caveat there with our repayment terms. For repayment periods above 2 years, we do require a 15% initial payment, and then we will guarantee 100% of that remaining 85%. With repayment periods of less than 2 years, the program is going to function very similar to GSM 102 in that there's no initial payment, and we will guarantee up to 98% of the value of the transaction. But like the GSM 102 program, we are mitigating foreign bank non-payment risk again under FGP. And so our guarantees under FGP, we can cover U.S. manufactured goods, U.S. services, such as any consultation that would be required to set up the piece of equipment. And we can also cover non-U.S. goods. So generally, we're looking for primarily U.S. content, 51% or more. So we can cover those non-U.S. goods as well. And so just a few things to keep in mind. So we are providing those payment guarantees, not direct loans. So it's best to think of this as an insurance-like product that we do charge a fee for, and we are mitigating against foreign bank non-payment risk. Importers, they need to open a letter of credit with one of our pre-approved banks to make payment to you, the exporter. And USDA, we're covering the holder of the payment guarantee. So that's essentially who we would make payment to in the event of a default on that LC. We do not provide any sort of risk assurance on the importer to the LC issuing bank. So the LC issuing bank would need to do their due diligence there. This presentation will be sent out afterwards, so I've attached some links where you can take a look at the program, as well as which U.S. and foreign banks are participating, and the fee calculator as well, so you can get an idea of the fees we charge. But we'll just go ahead and throw a number out there of around 50 basis points that'll fluctuate based on those variables that I discussed. We'll have time for Q&A at the end. But I certainly provided my contact information. So if something comes up after this session, you're always free to get in touch with me. And then I did just want to mention, I took a look at some of the top markets for U.S. almonds. So India, China, UAE, South Korea, Morocco, Vietnam, Mexico. So those are all eligible destinations under our program. And so, and also when I take a look at our historical data, I do see we have done shipments of almonds, not in quite a few years. The last shipment of almonds specifically was in 2012. But if we were to just say tree nuts generically, I see our last shipment of tree nuts occurred in 2017, so more recent. So this program has been used in the past, so I think certainly it could be used again in the future. And so I will stop there to turn it over to the next presenter.
All right. Nice job, Jeff. You went through a lot of materials. Now we're going to turn the floor over to Lisa, and we're starting to receive a few questions in the comment section here, but let's hold off on the Q&A until we get through the presentations. So this is Lisa Dow from CoBank.
Okay, good morning. Thank you for having me here today. I hope that you can see the presentation that I have prepared for you today.
Yes.
Okay. For those of you who might not be familiar with CoBank, we are a cooperative bank serving vital industries across rural America, CoBank is one of the largest providers of credit to support the U.S. rural economy. We deliver loans, leases, and other financial services, including agriculture export finance services, to farmers-owned cooperatives and other agribusinesses, including rural power, water, and communications throughout all 50 states. CoBank is a member of the Farm Credit System, which is a $503 billion network of banks and retail associations chartered to support the borrowing needs of U.S. agricultural and the nation's rural economy. As of year-end 2023, our assets were $194 billion, including $7.2 billion in trade finance loans to banks around the world for the import of U.S. agricultural products. We are the only farm credit system bank that has international lending authority. We received our authority in 1980, and we made our first GSM loan in 1982. We are recognized as the leading provider of trade finance and supporting U.S. ag exports, and we are one of the major participants in the GSM 102 program. Our head office is located near Denver, where we cover our U.S. exporters, and we cover EMEA, LATAM relationships out of the Denver office. Our Singapore representative office covers our Asia regions. So that's a little bit about CoBank. Our agricultural export finance division team is here to help you, the exporters, to mitigate your payment risk. We have the top 25 U.S. agricultural export markets that utilizes the trade finance products. We have over 100 foreign correspondent banks that we work with, that we have credit facilities in place that represents the most active agricultural import financing banks in those countries. Our active markets that we use the GSM program with are Bladix, Brazil, Colombia, Costa Rica, Panama, and South Korea. And while Jeff had mentioned there are many countries that are approved under the program, these are the most that CoBank works with at this time. Over the past 5 years, we've financed on an average of 225 GSM loans per year, totaling over $1.65 billion per year. So we are very active in the GSM market. Our team here in Denver and in Singapore has over 25 years of experience in trade. We also make semi-annual or quarterly in-market visits, depending on the country. And we also have a strong local market expert, people on the ground that we speak with frequently to stay current on conditions in the markets in the countries that we represent. Our trade services, we do not outsource any of our services or the operations that we provide. CoBank's trade services team is very educated in the GSM program. They have extensive knowledge. They're able to answer any questions that you might have, and they can guide you through the GSM process as you go along. Jeff had kind of mentioned, some of the process that the GSM loan does, but I am also going to provide you with a flow chart from kind of the exporter side all the way through. Once and this is an example for a 1-year loan with payments at maturity. So like Jeff had mentioned, once a firm sale contract is in place, then the exporter would apply to the CCC for a guaranteed for the guaranteed coverage of the sale, and the exporter would pay the guarantee fee. The USDA would then issue a payment guarantee to the exporter, and the exporter would assign that guarantee to the U.S. bank that's doing the financing. The importer's bank would issue the GSM 102 letter of credit, and they would send that to the U.S. financing bank. Once the U.S. financing bank advises the letter to the exporter, then the exporter would ship the goods. The exporter would present the documents to the U.S. financing bank, complying with the terms of the letter of credit, including all of the documents that are required by the CCC under that payment guarantee. The financing bank will examine the documents, and if everything is all in good order, then the financing bank will make the payment to the exporter, and then finally the foreign bank will make the payment at maturity to the U.S. financing bank. So, like I said, we are one of the leading providers of financing under the GSM program for the exporters. And I will provide you with a slide that has our team that is located here in the Denver office, along with the Singapore office, and the names of the people for the countries in which they represent in those regions. And again, we are here to help you identify and understand the risk that's involved when you have an international sale. And you can reach out to us with any questions that you may have regarding the GSM program, or how we can assist you with any of your exporting needs under different payment terms as well.
All right. Thank you, Lisa. So now next up here is Joseph Nutty from Acrisure, which is formerly the Trade Risk Group. So
hi, everyone. Are you, here it comes. Thanks for having me. Can everybody see the screen? Keith, can you see the screen?
Yes.
it's coming.
We can.
Okay.
Got it. Yep.
My name is Joe Nudie, but I've been called Nutty my whole life, so I get used to it. That's just the way it is, and you'll probably figure out why in about 2 seconds. Acrisure Trade Credit, we used to be called Trade Risk Group. It's kind of like Euler Hermes, who is the biggest trade credit insurance carrier in the world. They changed their name to Allianz, who owns them. Same thing with us. We're the 5th or 6th largest broker in the world. I only concentrate on trade credit insurance, and we're owned and operated in the United States. We have a U.S. corporate headquarters in Michigan. Okay. My experience is I have 20 years in trade credit insurance and 20 plus years as a banker. So great professions. Why do you credit insure? Well, because if you look at your balance sheet, and you bring up your balance sheet, your second line item is your accounts receivable. And depending on how you hold inventory, it's going to be your biggest asset. Okay. If you don't hold inventory, it's probably 80% of your assets. If you do, it's probably around 50%. The biggest question we get asked all the time for credit insurance, and this happens for you in your industry because margins are tight, is it's too expensive. It's probably the cheapest of them all over LCs. However, too expensive, you need to put it in perspective. Okay. If you take a $50,000 hit, non-payment of 50 grand, and your margins are 2%, you've got to sell another $2.5 million of product just to break even to pay for that, to get you level with that $50,000 loss. So take a look. Does it make sense for you? And we can help you with that. It doesn't cost you anything to apply, and you get your top accounts underwritten for no cost at all. So it tells you the credit quality of your customers, which is a good review process to have. So what is trade? The policy holder would be the seller. And I have numerous people in your industry, so I'm very well versed. In 2016, when the disaster happened in your industry, we got over $4 million in claims for numerous policyholders paid. A lot of them were, of course, in India and UAE. And this is the customer, okay? And we're the broker in the middle, and the insurance companies are here. So the top three are Allianz, Atradius, Coface. Worldwide, they review the buyers, they monitor the buyers, and they are the collectors if you file a claim. The other carriers who are large, AIG is a well-known carrier, they'll let you approve your customer. Now they're hybrids of all. So, and James is going to cover that. So we're going to go through this quickly. Whole turnover, what kind of policy you can get? You can insure all your receivables, domestic and export. You can insure just your exports. If you have a bank line of credit, like for example with Wells Fargo, for them to advance on foreign receivables, you have to have credit insurance, okay? You can do a key accounts policy, which means you can just do your top 5 to 10 customers, okay? And then you can do a single debtor policy. This is where Exum does well for this industry in single debtor, okay? Oops, hang on a minute. You can get a policy that's cancelable coverage, AIG, Atradius, Coface. They also have hybrids, non-cancelable, AIG, AWAC, FCIA, or you can get a hybrid, okay? Limits underwriters are those top 3 again. Excess of loss are the AIG, and the one I'm going to talk about, and we do them all, is Exum, okay? Exum offers, you have to have 51% US content, and it's a non-cancelable policy. Where does Exum fit in for us? It fits in that it's very good for small deals and one-off deals, okay? What's covered? All credit insurance covers insolvency, bankruptcy, slow pay, political risk. It will not cover disputes. And I'm sure some of you have run into that in your industry. Okay, so again, what does Exum do well? It covers 95%. It covers small companies. If you talk to them, they realize if the policyholder has 5 million or more in sales, that they're going to go to the private carriers because the private carriers are cheaper on average, and they are. They have their niche. Their job, their charter is to promote U.S. exports, okay? Now, here's a key thing in your industry. How are you selling? If you're selling on terms, then that whole market opens up to you. Net 1 to net 180, the whole market opens up. If you're selling CAD repayment terms or SDDP, which our industry does, then it limits you to the top 2 carriers, okay? And why is that? Because you need an endorsement, a critical endorsement called non-acceptance of documents, also known as contract repudiation. They're very selective. Their minimum premiums are around $50,000 annually for those deals. And you have to be very cautious that you know what you're getting into. And that's why a broker is important. Guess what? Exum does not offer non-acceptance of documents in commodity business. So if you're selling CAD, again, the key for you is, do you get receipt of goods? Did the bill of lading get signed off that they received the product? In the lending business, we call it proof of delivery. Do you have proof of delivery? If you have proof of delivery, you're all set. You can use any of them. However, you know what happened in 2016? The prices tanked. And what are the 3 most dangerous countries when this happens? India, number 1. All the claims were in India and in UAE. Turkey has now, as of a couple of years ago, become into that problematic area where government intervention takes the side of their customer over U.S. seller. Saudi Arabia and South Korea can also be difficult, okay? non-acceptance of documents. And those two top carriers are starting to limit what they'll allow, what countries they'll allow non-acceptance of documents. So again, back to Exim, if you can get that proof of delivery, you're all set because they will cover SDDP terms. Okay. The coverage details, again, it's a $500 buy-in. You're going to have a policy for $500. How do you qualify buyers? The benchmark is around 300 to 500,000. You get a credit report. Okay. Remember, it's the U.S. government, so it's not the private carriers. You have to you have to go online, fill the application out. We help you with that as a broker. We help you get a credit report. There's a third-party service you buy it from, and you submit it all online, and they'll give you an answer whether they approve it or not. Okay? They're pretty good in time frame, but they're not as fast as the private carriers. But again, they'll do small deals. So, and they don't have the limitations by countries that the private carriers do. The private carriers like exclude a lot of Africa and exclude Russia. Exim doesn't exclude those countries. So there's something that they will that the others don't. This is here where you have a buyer of 100,000, you really need credit reports. That's the easiest and fastest way to do it without getting into too much detail. These are all the carriers we provide quotes for market quotes. And if you do, always go through a broker, always go through James or myself. And the reason is we don't work for the insurance company. We're your advocate. Okay? Of course, I get paid if you buy a policy. However, my job is to reduce the amount of contingencies, keep you informed, be an intermediary with the carrier, and to protect you. That's my concern. And so that's basically what the insurance is for Exim. There's something that happens in your industry, and that's get to know your customer. It's very competitive in your industry. And sometimes when there's 3 sellers, the buyer will choose the one they don't have to get the LC from, or that they don't have to provide financials from. I did some research on your behalf with the NACM, the National Credit Managers Association, and I gave Keith that information. Think about establishing your own NACM. It's to your benefit, and they help you with that. So you become one body that finds out, did that guy stiff you 3 years ago and then close his business down and then had his mother open the business, and then he's behind the scenes and you're selling to him again. You just don't know it. And if you're all together and you all talk, that's the best way to defend yourself from non-payment. So if you have any questions, we can talk at the end. I know I was too fast, but I got 3 minutes left, so I didn't want to waste your time.
All right. Good job, Joseph.
Thank you.
Now we're ready for James Tiarks from Meridian Finance to go through his presentation. And I think even after this webinar, we're just covering a lot of material, so there will definitely be some follow-up afterwards. So James, you're on mute.
Sorry, there had to be one. Yeah, no, thank you, Keith, the introduction, and Joe, thank you for explanation on what you do and Exim Bank, and I hopefully try not to sort of repeat any of it. And like Joe says, I'm going to provide a little bit more insight on what we call the private insurance market or private credit insurance market. And so I'm also a credit insurance broker, or Meridian is a credit insurance broker. So I don't want to sort of, Joe and I are doing the same thing or trying to do the same thing. So I don't want there to be any confusion around that. But we decided to pick 2 different sides of the market. So lovely to meet you all. My name's James Tiarks. I'm the managing director at Meridian Finance Group. We are a Texel Group company. I'm based here in Los Angeles, and we have offices in New York in the US. I'll go into a little bit more detail on our presence and a little bit more about the group itself. Meridian Finance Group is a specialist credit insurance broker. So just to sort of emphasize, it is the only line of insurance we do. We don't do any other lines of insurance. So hopefully we like to know what we're talking about when it comes to credit insurance. And I will just again sort of reiterate, we are the broker. So we work with all of the insurance companies or major insurance companies offering credit insurance in the US, but we work on behalf of our clients, and we place business with the insurer. So quite often you might tell my accent isn't from these parts, but I've sort of worked in the UK and in London and in Asia and Singapore for a long time, and perhaps the use and knowledge of credit insurance is a little bit more than what it is in the US. And sometimes in the US, I do come into instances where people sort of say, yeah, I know insurance, I work with someone, and they actually work with an agent for the insurance company. So it's just a sort of clarification I wanted to make. So a little bit on Meridian. Meridian, as I mentioned, is a Texel Group company. We were bought by Texel back in 2017. We are a specialist credit and political risk insurance broker. I will focus on the credit insurance piece here, but we also do political risk. And I'm happy to take questions at the end and provide a little bit of information on that. But I thought it was important to focus on the credit piece here. And I'll get into more information, but we do work with all the major credit insurance providers, including Exim, which Joe touched on there. So we make the differentiation between the Exim insurance market here in the US, supporting US exporters, and also the private insurance market, which I'll go into a little bit more detail on. As mentioned, we are owned by the Texel Group. It is a London headquartered company with offices in London, Brussels, Singapore, and then in the US, we do have New York and Los Angeles, our two main hubs. Outside of Los Angeles, we do transact under the name Texel Americas in the US, and then in the rest of the world, we are known as the Texel Group. But the team that I run here in the US that focuses on short-term credit insurance risk, which is typically AR risk, dealing with accounts receivables, and what we call the more short-term credit insurance space. I run the Meridian team that is based here out of Los Angeles. I would say 60-70% of our clients are US exporters and US and selling domestically here, US corporate, selling domestically and exporting. And then we also work closely with financial institutions ensuring their own exposures. So whether that be the LCs that are being confirmed, or they're lending to our corporates and they use insurance for either their direct exposure under an RCF or a term loan or a borrowing base, or they are sitting behind a credit insurance policy to facilitate financing, and they are what we call the loss payee under that insurance policy. So that is a little bit of background on myself, Meridian, and the Texel Group. I will say I've worked in London, Singapore, and now in the US, so I have a fairly good grasp of how the credit insurance market works globally. We work as the broker. We work with all of the major credit insurance providers in the US. And at the moment, you'll see here, some of these names you'll probably be very familiar with. Some might be new to you. There are about 15 private credit insurance providers here in the US. We do also have access to the full market globally. So that includes European company markets and also Lloyd's of London. And so in total globally, I would say there's about 50 insurers in the world that are offering some form of credit insurance. But for our clients in the US, so if I'm working with a US corporate, whether they're selling here domestically or internationally, we would typically reach out to these insurers pictured here. As Joe touched on earlier, the likes of Allianz, formerly Euler, Hermes, Atradius and Coface are monoline insurers. They provide a large market share for credit insurance here in the US. They can be accessed through one of their agents, but they also work with brokers. We work very closely with them. The other insurers outside of that are mentioned in this slide, you can only access those through a credit insurance broker. So again, I'm not here to sort of sell the use of a broker, but it does highlight the benefit of going through an insurance broker to access the private insurance market. I will just say you also need to use a broker to access US EXIM, who we work very closely with. But it does show if you're looking to use insurance for the first time, credit insurance for the first time, or you're a current user but would like to see what else is out there, I do think there is a lot of benefit of knowing the full market. And at the moment, we are seeing a very competitive market in the credit insurance space. That is, there's a number of factors contributing to that, but I would say there's a lot of excess capacity, a lot of new insurers coming into our market, and perhaps they've not seen the claims that everyone thought that would happen. So with a lot of excess supply and capacity, a low claims environment, low loss ratios, we are seeing pricing being very competitive. I'll touch on how the private market prices the risk a little bit, but it is very cheap at the moment, or very competitive. I wouldn't say cheap. Just quickly, Joe did mention this, but the private insurance market can typically be broken down into what we call non-cancelable, cancelable, and hybrid insurance providers. A non-cancelable limit is a limit that is provided to our client, and you have that limit available on your customer for the 12 months or 24 months that policy is in place. A cancelable limit is one that is provided to you, but at the insurer's discretion, they can issue you in sort of 30 or 60 days notice. They can take that limit away. It doesn't happen a lot. I will say that during COVID, there was a lot of reputational damage to our market because a lot of insurers pulled a lot of limits, but that is very rare. I will say a limit is removed for, annoyingly for good reason at times. It can often be a lack of financials, or they have financial information available that requires them, or there might be a downgrade. But I will say the market is trying to do as much as they can to improve the reputation about cancelable limits. There is also a hybrid offering that insurers will make. I will say of the EULA, Atradius, Coface, they will be able to provide cancelable, non-cancelable, and hybrid policies. The other insurers, which you typically will have to use an insurance broker to access, they will provide non-cancelable limits. So again, depending on what you're used to, if you've ever used credit insurance before, and also particularly if there is a lender sitting behind that credit insurance policy, having a non-cancelable limit in my mind is essential, because the limit is only as good as it's there. And if it's cancelled and you're borrowing against that receivable and it gets taken away from you, then you're just reducing your collateral and borrowing base. And, it's just, takes away from the whole reason. If you're being forced to buy this by your bank and that limit is removed, then you're really taking away from the whole reason of buying it. So in my mind, whenever there's a financing element, I do try to push a non-cancelable limit, just because of the use for our clients. Right, next policy. I will try to get through this. I know the clock is ticking, so very quickly, and I don't really have a chance to get into too many specifics, but like Joe mentioned, there are various ways of looking at it. You can have a whole turnover policy, you can have a key buyer policy, or you can have a single buyer policy, depending on what the requirements are. Premium in the private insurance market is often a fraction of a percent. So at the moment, I would say desk quoting anywhere from 10 to 40 basis points against insured receivables. To be honest, at the moment, typically the more receivables you're including in that insurance portfolio, the more leverage we're going to have with the insurer on pricing. 10 basis points now, to be honest, we're seeing pricing going well below 10 basis points. So I don't want to sit here and be quoted on it, but 5 to 10 basis points on a very, established customer is not unseen or unheard of. And that also, we're not talking billions of dollars of insured receivables. We can see very competitive rates at the moment in the sort of 10 to $50 million of receivables. So just to give you an idea of where the pricing is at the moment. Claim filing, importantly with a broker, you can go through that, you can help that. For insolvencies, it often has to be immediate, and then you have a more flexible window when it comes to a protracted default. There is always going to be an element of risk sharing. So depending on what structure you go for, you might have a deductible included in that insurance policy. So there will be some self retention of that risk. The indemnity, I would say more typically at 90%, but depending on the client and the structure, we can push for 95% in the private insurance market as well. But I would say, as a guidance, up to 90% indemnification is a guide. And then in the way, I'll very quickly just touch on the limits. So insurers will provide named limits, very clear. You have $500,000, a $50,000 limit on said buyer. That is a named limit. It's easy to use. You know what you have. You can go through the broker to increase that or decrease it during the policy period, depending on what your requirements are. You can add new buyers to your policy. It's an evolving insurance policy. And then you have what is called a discretionary credit limit. So depending on the structure, if you have a named only policy and there's no deductible, then typically that's what we call a ground up insurance policy, and that won't come at a discretionary credit limit. But we do also have structures with carriers where quite often there's a deductible. You'll get what is called a discretionary credit limit. So you'll have a host of buyers that are named, and they will then effectively, the insurer has confidence in the insured or the client they're underwriting. They will hand the pen over to you and give you a preset limit that you can apply to any customer as long as they pre-qualify under that discretionary credit limit. And you ultimately have to make sure that you have the country limit also. Oh, sorry, is anyone able to see?
Yeah, we need
my
your slides
slides
back up. Yeah, please
Yeah, that's
share.
okay, James. You can reshare again. It just came down for a second.
Oh, I didn't see that. Apologies. I didn't click anything. So
Yes, we can see them.
They're back.
sorry, it probably doesn't. So I don't know where I lost, but this was the sheet I was just talking through. This was the previous one, and this here is the discretionary credit limit. So I'll quickly get through it. Discretionary credit limit is a limit that you get if it pre-qualifies through your ledger experience or a credit rating. Then effectively you have a very flexible insurance policy that allows you to get coverage up to a certain limit without having to get pre-approvals from the insurer. So I sped through that. Thank you very much for listening to me. Hopefully you found it interesting. These are my details. Please reach out to me after this or after the whole presentation if you have any questions. And yeah, no, thank you for letting me speak.
All right. Thank you, James. Now, Danielle's up from Umpqua Bank.
Thank you and good morning. And thank you, James. And thank you, Keith and Julie Adams. Very delighted to be here. We are very familiar with these programs. A big advocate of Exim Bank. We were Lender Bank of the Year in 2023. And also, I've been advocating GSM 102 for many, many years. It's such an awesome program for U.S. exporters. Been involved in the almond industry for about 10 years. I think I've been to about 7 conferences. And in international trade for 30 years. So I'd like to present, I'm assuming you can see my material here, but I'd like to present, the ease of the letters of credit. There's so many misconceptions out there. And so I'm in the mindset, still as an exporter myself, then later recruited by the banks, but I'm in the mindset is to use these to your advantage. I want to create an environment where there is an ease to LC. So I'm going to rapidly go through this material to try and take that intimidation factor out of it. So number one here, LCs get a bad rap, the misconception. But you know what? They still are the safest way to do business. And I'm going to show you ways to use these to your advantage so you're not paying any bank fees. I always want you to be in control, and I never want you to pay for bank fees nor logistics. So I'm going to rush through this to give you some tips and tricks. LCs don't have to be expensive. Actually, you can offer terms and pay nothing. So I'm going to walk you through even a simple spreadsheet on this and to utilize the rate arbitrage to your advantage. Number 3, use the LC as a secured sales tool. So in the old days, we always used LCs for risk mitigation, but they're now being used as a sales tool. So I'm going to show you the win-win of both sides of using these LCs. And then how are these LCs secured? We talk about, wow, they're a secured international sales tool and for risk mitigation, but how are these secured? So just as Jeffrey had mentioned, as well as Lisa, in order for a foreign buyer to issue a letter of credit, they're using their line of credit. So they're either using their line, they're putting up cash, or they're using collateral. So if an LC is issued for $200,000, they can't delete that. They can't cancel it, reduce it in value, or amend it without your written consent. So when you receive a letter of credit, it's like 200,000 cash. And then there's, I'm going to walk you through looking at these, but if an LC is issued, again, it can't be reduced in value or canceled. So number 5, sometimes we think as an exporter, ooh, the safest way to do business is cash in advance, but really there's risk in that. And also it's really not good business practice for our foreign buyers because they don't want to send you 200,000 in cash, right? They're just hoping every day you're going to make that shipment. So there's risk in it also by a lot of, even on, I see clients, I've been in the almond industry for a long time, but I see clients even using the WhatsApp and then they're sharing account information. And I'm thinking, gosh, don't share your account. You don't share your ABA. All of this has to be protected because there's so much fraud going on. So that's another reason I'm saying, hey, cash in advance, there is risk involved. And then number 6, LCs are authenticated. So when they're sent via SWIFT, it's instantaneous. As soon as an LC is issued, it's received by the U.S. bank. It's irrevocable, meaning, again, it can't be changed, deleted, or amended without the beneficiary's written consent. And then in some of the best practices, LCs you can add these back into your borrowing base. So if you're on an asset-based lending, just like with trade credit, you can add that back into your foreign AR because typically bankers see, what are your international sales? And you say 85, 90%, and they think, ooh, we need trade credit insurance, or hey, we got to support these through letters of credit. So the good news is you can add these back into a borrowing base. B, you can create consistency for every single letter of credit, regardless of what country it's coming into, by using these LC instructions. So I've created LC instructions so you don't have to reinvent the wheel. So when you're using LCs, you pass these instructions around the world. So that way you guys can control the structure of the LC, reduce the number of documents, reduce amendments. And as I'm talking about each one of these, they're bank fees. So ultimately, by using these LC instructions, you're in control, you're reducing documents, amendments, and ultimately bank fees. So C, I wanted to give you this analysis on how LCs can be quick and easy. So once you're using these LC instructions, typically an LC can be issued in one day. Of course, you're going to do your KYC and your due diligence. We have to as U.S. exporters. So you're going to check out your foreign buyer, and then you're going to provide your LC instructions. An LC can be issued a day or two. It really depends on when your foreign buyer wants to access their account, utilize their credit, right, or put up cash or collateral. Then the LC is advised. Remember, it's sent via SWIFT, so that's instantaneous. The exporter audits the LC. We help you with that, as well as CoBank. We all help you with that. We want to make sure you understand and that you can comply with this letter of credit. Then let's say you can comply. You release the shipment. So here we are, day 3. You can present documents. The goal is to present your documents within 3 to 5 days. You can use your LC to help copy paste information into your ERP system. So you're doing your own doc prep even by utilizing the LCs, because typically the LCs are digital now and you can just copy paste them. So you want to present your documents, obviously, to the bank. The faster you present your documents, the quicker you're going to get paid. Typically on LCs, this is the most fantastic part of all, is we are paying clients within 3 to 5 to 10 days. So you're typically seeing payment on a letter of credit sooner than product even arrives in the other country. And the reason that is, because some people don't believe this, is because you're using these LC instructions to help structure that letter of credit to keep it super simple. So I always want you to be in control from sales negotiation all the way to payment. And I never want you to pay for bank fees. And I'm going to show you how to do that. So number 1, use the LC itself, like I said, to help create clean documents. I don't want you to have discrepancies. And this is where you hear a lot of chatter and static in the industry. Gosh, LCs are so complicated, but they don't have to be. And that's why, we're here to help you keep this process super simple so that you're using the LC again into your ERP system to create those documents and to make them clean. So number two, yes, every discrepancy is avoidable. And that's why you want to look through the LC. You want to provide those instructions. We help you audit it by the third letter of credit. And I know I've seen people on this call, they'll say, yeah, we're committed to help walk you through this LC. Is to avoid those discrepancies. I never want you to have discrepant documents. It puts you in a vulnerable position or at the mercy of the foreign buyer. So number three, use an LC as a due diligence tool. So think about it. I know your industry says, hey, we don't use them, although there are some that do, is they say, well, our client, our foreign buyer can't issue a letter of credit. So that I'm saying use it as a due diligence tool because if your foreign buyer can't issue an LC, then it's a little bit more risky if we're doing cash against documents and they may not have a line of credit. So it's a wonderful due diligence tool as well. So my motto I use all day, every day is LCs can help you ship around the world by offering extended terms to your foreign buyer. You get paid in days sooner than product even arrives in the other country. It's 100% secured for zero bank fees. Yes, zero bank fees. It's leveraging the rate arbitrage to your advantage. So this is what I'm saying as far as leveraging the rate arbitrage and how you can shift these fees to your foreign buyers and they'd be delighted to pay for them. So again, I'm in the mindset, I don't want you to pay for bank fees nor logistics. So here's a typical scenario on the sales side. So the foreign buyer is asking the sales team, hey, can you give me 60 days? And the seller and the sales director says, sure, I can give you 90 days or 120, maybe even 180. And what's awesome through the GSM 102 program, like Jeff was saying, they're talking about 18 months. So this scenario through a regular banking relationship, typically we can only offer maybe 180. And with ag, sometimes that's limited. So that's another great thing about GSM 102. So back to the scenario here. So the buyer's asking for 60 through LC coaching with the sales team and obviously the finance department within your operation. Now he's saying, well, listen, we can offer you 90 or 120. I know you're only asking for 60. And then the buyer will say, so he'll say, but what are your in-country commercial borrowing rates? Because he's asking for you to finance it for 60, but you're saying, hey, I can give you up to 120 days, maybe even 180. What are you paying? What rate are you paying? And so you navigate that as the exporter. So your foreign buyer will say, and this is just an example, they say, oh, we're borrowing at 14%. And we think, wow, 14%. So this is the new language. So you say, all right, well, listen, issue me a letter of credit. I'll give you 180 days at 7%. And this is what you navigate through us and through the banks to give you these rates. And this is where we even partner with GSM so that we can give you this rate. So now the foreign buyer is saying, wow, 7%, they're running to the bank to have access to this rate. And you as the exporter is 100% secured. So I crafted this very simple spreadsheet, and here's the math. Here's how it works. And the sales directors love this because they're selling all over the world saying, hey, Danielle, what's the rate for Korea, Tunisia, Morocco, wherever we are shipping in Taiwan or Malaysia. And so we'll give indicative rates. And just like the USD program, there's people that are analyzing foreign country risk, political risk, availability. And so they're not always the same. So I'll say for an LC, let's say to India or Malaysia, indicative rates might be 7%. So in the yellow area, we're filling this in. So the discount rate, that's what it's called when you're offering financing through a letter of credit, is 7%. You, through your conversation, through your sales negotiation, find out that their in-country commercial borrowing rate is 11 or 14. So you're plugging this information here. The LC value or the shipment is 500,000. The tenor of the LC, the usance clause, the deferred clause is 180. So the cost to discount the letter of credit offering the financing at 500,000 at 7% is 17,500. The cost if the foreign buyer were to finance it through their in-country commercial borrowing rate is 27,000. And so see the rate arbitrage between the two, the discounting of the LC, or if they were to borrow in country. So the cost saving to the foreign buyer is $10,000. That's why they'd be running to the bank to have access to these rates. And this is when I say, all right, so since there's a rate arbitrage here that is pretty great, is that all charges, structure of the LC, all charges for the account of the applicant. Why wouldn't they pay a couple hundred extra dollars when you're giving them a cost saving of 10,000? I mean, again, you can fluctuate, obviously, the numbers in here. It might not be a $500,000 shipment. It could be a $75,000 shipment, but there's always going to be this arbitrage. Typically, sometimes in some countries, it's not as large, like maybe Canada and Japan at one time, but it's just such a great tool. So many banks, when we're talking about these programs, we always talked about the payment scale of risk. And so cash in advance, sometimes I call that sales prevention. The risk, again, I want you to protect your account information. LC, so anything above that black line is 100% secured. You have our partners here, the trade credit insurance, and then the USD, GSM, as well as Exim Bank. And then below that, and I know the industry does most of this, it's mostly cash against documents or documents against acceptance or against payment. And, unfortunately, it's unsecured, as well as your DSO, your day sales outstanding, is still 45, 60 days. And our risk is once we release that shipment, is that we're hoping and praying they're going to accept the shipment and that foreign bank actually does what they're supposed to do. And they're supposed to send you the wire first and then release the shipment. But that's a lot of responsibility to put on a foreign bank that you don't have a relationship with. You may not have people in country. And so I'm just so glad we're here on this call today to just help educate one another and to protect our almond industry. And then you also have, open account. It's unsecured. Obviously, it's higher risk. And there's no such thing as international law. If we're doing a contract, we want it based on U.S. law. Maybe the Koreans want it based on Korean law. So that's where the LCs can help bridge that gap. And so thank you, Lisa. She also had a very similar flow chart, a flow here of, how the LCs work. So anything on the left, it starts with the importer bank number one. The importer, the buyer, goes to their bank. They send it to the U.S. bank, and then we send it to you. It's an authenticated letter of credit. All U.S. banks have to do a due diligence on all parties, the issuing bank, the applicant, and then, of course, the beneficiary. Then once you audit the LC, you release it, and then you send those documents to the negotiating or the examining bank for payment. So another great thing, the sooner you send your documents to the bank, the faster you'll get paid. And this is where if, you're sitting on cost of funds, if it's $5 million and you're using cash against documents at 60 days, if you can decrease that down to 10 days, then you'll free up additional working capital on the AR side. And then LC instructions, it's just really important to use these as you dive into letters of credit. You just don't want to be at the mercy of it. You want to take control and say, hey, world, this is how we want our LCs issued. And so we can help you with that. And we want to be very specific with that. And also we want to pay attention to your Incoterms. I want you to be in control from sales negotiation all the way to payment. And I also want you to contract carriage and bill back that freight. And so if they're talking about what's your FOB shipment, you say we contract carriage, but I'm sure I can get you a competitive rate. Now you just brought all the control in-house, because in order to get paid under a letter of credits, invoice, packing list, and proof of shipment. So we want that freight forwarder working for you to produce that clean bill of lading. So there's our sweet spot within the Incoterms to contract carriage, the C terms, and then, just being in international trade for over 30 years, my passion is to help protect you. I still think I'm an exporter. I just happen to work for a bank. But, partnering and holding the hand of the exporter, pretty passionate about to protect your sales. Been involved in international trade. Like I said, I sit on the BAFT Trade Finance Committee. I co-chair, as well as the letter of credit and the collection committee. So, we're all here to help you. And I just thank you again to the Almond Board and all of my partners here. And we hope to be your resource. Reach out to all of us with all your questions. So thank you so much.
Wow. I'm impressed. You guys really kept right on track with our schedule. So now we have another 20 minutes here where we could have some Q&A. And one of the questions here that hasn't been answered yet is what is the average cost of an LC? And Danielle, do you want to give us a rough idea of what that might be?
Certainly. And I was researching this as this came in. So I'm just going to share a screenshot here real quick. And typically all banks are the same. I mean, an advising fee, you can see this here, right? Advising, it's usually about 100. And then if there's an amendment, so let's say an LC comes in and you need something changed, whoop, you spelled the company name wrong, that's an amendment. The U.S. exporter pays, so does the importer. So the importer doesn't want changes either. That's why they want your LC instructions. So maybe 85. The examination, it's usually 1/8% with a minimum of maybe 150. The usance clause, which is the financing piece, I quoted there 7%. So there's a way to calculate that. Happy to do that. And then, so I say if it's just a basic LC, it could be $300 to $600. So, or 300, right? An advising fee, examination, maybe an amendment. I don't want you to deal with discrepancies. So we have to talk through that. Reimbursement fee to send the money. There's SWIFT charges. But again, if you're using the rate arbitrage, all these fees can be structured so that it says all charges for the account of the applicant. So hopefully that gives an idea there.
And could you talk just a little bit about that usance LC? That's something we had talked about before that might also work under the GSM 102 program.
Yeah, Jeff, do you want me to take it and you piggyback?
Oh, Jeff, you're on mute.
Okay, cool. So I read his lips. Okay, so so a usance clause is an LC with terms. So there's a site LC. I call that LC 101. Just a site LC. There's no advantage to your foreign buyer except he is leveraging his credit. LC 201 is you're offering extended terms. So a 60-day, 90, 120, 180. So you're allowing your foreign buyer 180 days to really pay his foreign bank back. But we can discount it on the U.S. side, pay you in days, and that's when the clock starts ticking for your foreign buyer. So we pay you the full 200,000, and the clock starts ticking. At the end of the maturity of 180 days, we debit the account of the foreign bank, or we request the payment, and then your foreign buyer remits the payment through that channel. And then LC 301 is using the rate arbitrage. You say, hey, I'm going to discount this. Well, I call it LC 301. You figure out that they're borrowing at 14, we've offered you 5, you go, wow, we can offer 7 and make a little additional margin by leveraging this rate arbitrage. So I'll kick it back to Jeff to talk about on the USDA side of the usance LC.
Yeah, so I would just say that we do cover usance LCs, and so the coverage would be 97% of the value of the transaction there. So I would just add that. But doable under our program, yes.
All right, and then Joseph, a question kind of related to that. Then, if the buyer is using a usance LC, that also helps kind of deal with this whole non-acceptance of documents issue that you were referring to earlier.
Yeah, the LC are guaranteed funds.
Yep. So they have to take the receipt.
But again, there's a cost to it, so you know that has to be reviewed.
All right. Well, if anybody wants to ask a question, you can raise your hand in the system and ask. Otherwise, I did receive a few other email questions. So I'll start with the first one that I received here in an email. So it says, do any of these credit insurance programs protect against default prior to loads shipping? Currently, coverage only applies to loads on the water. Any response to that?
So
James.
Well, I was just going to say, for us, obviously, it's being able to fine tune when title is transferred for us, and depending on which sector when and where that happens. So I mean, there might be an issue, perhaps in the example being if you're looking at a US export and EXIM cover with regards to where that title transfers. So I would say the private market is obviously going to be a lot more flexible when it comes, because they can cover both domestic and exports. And so again, without knowing too many specifics, I think it probably comes down to the insurer and how they view or where they view that title transferring, whether it is pre the shipment on the water, if that helps.
Okay. All right. Let me go on to the next question I have here. Do any of these programs support new companies overseas in emerging growing markets that don't currently have the financial information private insurance companies require? I guess that's trying to come up with their financials.
Yeah, I mean, it's one where the private market, the likes of Allianz, Coface, and Atradius, if they don't have that information, they will ask, or they will try and go out and get it. They have some of the largest databases in the world with regards to financial information. Quite often it can be a useful tool as well. If an insurer has little to no information available on that buyer, then that can be something that's useful as well. They can also, I mean, if it's a new customer of yours, it's obviously, Ledger is going to be impossible to sort of, or not, it's not going to provide any benefit. But we do see, particularly in the current marketplace, when we're looking at insurers' ability to approve limits outside of the financial information, that there is flexibility there at the moment. So for a pure new customer, then you are going to also rely heavily on the credit report. And if that credit report doesn't have much information or doesn't have much good information, yes, it is going to be difficult. But as soon as you were to have some traction or you were to have some ledger with that particular customer, then you could look at perhaps trying to place it under a discretionary credit limit, like I mentioned before. So there are different ways of trying to either get the information. The insurers themselves have teams that reach out and get that type of information. But yeah, a long way of saying there will be certain limitations, particularly for foreign buyers where there is little to no information available.
That's an LC deal.
It's another LC deal. Yeah. All right. Here's another question kind of related to the electronic bill of lading and digital LC. So here's a question. How is the banking system evolving to fit into the paperless environment? Many almond exporters use direct collection, but that still relies on hard copy originals.
Lisa, you want to take that or you want me to?
Well, that is definitely a topic of choice every time the bankers get together, because we are working with so many banks in so many different countries that trying to get something uniformed when it comes to the digital processing has definitely been a challenge. It's something that's being worked on every day, but yet we don't see that, we're going to see something in the near future regarding the digital platforms.
We will, and we have transitioned to that during COVID, much more so than we would have anticipated. So it did scoot along. There is a feature within Swift that does allow you to upload documents electronically. We are there as far as PDFs and advising LCs. That's why I was saying you can copy and paste it from a letter of credit. Now, the push also is to ask all of your foreign buyers when issuing an LC to issue per EUCP, which means it's an electronic form of the UCP, which governs LC, the Uniforms Customs Practice. So we're there. We're on the cusp. We have digitalization committees already established within BAF. So we're constantly, like Lisa just said, we're all chewing on this all day, every day, and we're getting closer and closer every day.
Yeah, when I was still at USDA, I heard some, well, I didn't just hear, but I know there were some examples of some companies that were doing fully digitalized shipments of, bulk soybeans, like cargo from the Gulf of Mexico all the way to China, and everything had been done digitalized from the LC to the bill of lading to the phytosanitary certificate. So, and then some are using blockchain and others are, different types of systems, but that could be the way of the future. And hopefully that will also help lower risk down the road, but we're not quite there yet. Okay, are there any other questions? I don't see any hands.
There's one more popped up in the chat.
Okay. On average, what percentage of LC documents are accepted as presented without the need for approval of discrepancies in documents?
Okay, so on average, and I did take this out, a 10-minute presentation on LCs, it was kind of hard, but 99.99% of LCs are paid. Yes, there are discrepancies, and that means when there are discrepancies and the bank calls you, they always say, hey, do you want to correct them? There's soft discrepancies, meaning that you can correct it. There's a transposition error, you fix it, resend it, or submit it electronically. We do that. Or there's hard discrepancies. You missed the last ship date. So therefore it goes on approval, which means it's on open account. So you're right. It's up to the foreign buyer and that bank to release the payment. But even after that, 99.9% are paid.
And I think that's a, good reason why you have a strong relationship with your bank, because we're working with you to reduce the number of discrepancies we see. We're here to train you, to help you to avoid those, and to work with you just to prevent that, because that's the last thing we want to do is have to call a discrepancy, especially one that you cannot fix.
All right. I have another question here. Since Incoterms define transfer of liability, what Incoterm do you recommend using for exports to Mexico and Canada? It says you're essentially giving up ownership of the cargo when the truck leaves your facility. Any experience there working with shipments to Mexico or Canada?
I'll hop in real quick. Just an opinion, even being a U.S. exporter myself for as long as I've been on the banking side, I always want you to be in control. I want you to contract carriage all the way to name destination, whether it's Mexico, Canada, Korea, Tunisia. And then that way, that freight forwarder works for you. It's in your possession. It's actually your own inventory in transit. But that's my opinion. I don't think that we should, as U.S. exporters, just hold our hands and say, I don't want to deal with logistics, because now you're right. You're relying on the foreign buyers, freight forwarder who doesn't work for you, to pick up your precious cargo. Number one, U.S. exporters aren't even asking if there's freight cargo insurance, right? If you're doing an X-Works, FCA, FAS, FOB, typically the U.S. exporter isn't asking if there's insurance on top of it. The insurance comes with the CIP or CIF Incoterm. So naively, a lot of U.S. exporters are just by default using Freight Collect. So I'm suggesting I want you to always be in control. You contract carriage to name destination. And if you can bill that freight back, I don't want you to pad pricing. I think you should GL that out under freight. But if you can bill back that freight, all power to you.
All right. It looks like the last, I think you just addressed that. Do any of these insurance programs require exporter to hold title until cargo arrives at the destination port? And it sounds like they would all cover that. And then the last question is transfer of liability, transfer of title are two separate things. My computer just blinked off on me here. My screen. Let me pull this up. Okay, sorry. Transfer liability, transfer title are two different things, but how are they viewed when it comes to covering credit risk? That's the difference between transfer of liability and transfer of title. You see a difference?
Yeah, I mean, I'd have to, it would, again, I probably am not without knowing the actual underlying itself, it's hard to sort of know how exactly the insurer. I mean, what I would say is if we are working with you, or whoever you are working with, that from day one, that is explained to the credit insurer, and it is very clear and transparent as to how the contract is and on what basis you are selling those goods on, because quite often a solution can be found, but it's often not going to be a pretty situation if it is only disclosed at the end of, or if there is ever an issue. So I think any sort of transfer of title, transfer of liability discussion should be had with the broker and the insurer, and so that is made clear from day one.
Okay. Well, I don't see any more questions coming in. But I know that in the past 6 months, we've heard of a couple of instances where a couple of companies had shipped product. One company shipped to Korea, and another company had a shipment going to Italy. And it sounds like it was all cash against documents business. And the banks in those two countries actually released the documents or title to the importer before the payment was made. And that's just another risk, I guess, of doing business in this way. But are there any international organizations that would be following that type of activity or misbehavior by foreign banks, or does it just come down to the foreign bank against the exporter in that case?
Yeah, this happens all day, every day. That product works until it doesn't. And then when it doesn't, there's a sense of urgency. And, we're always looking out, just like Lisa's nodding her head as well. We're always looking out for our clients. We do as much as we can, but with cash against documents or direct collections, there's nothing we can do to make those foreign banks pay you. We can't. But with an LC, it is secured. There's a guarantee of payment. So that's why I'm even saying use it as a due diligence tool. I know it seems intimidating, but what's wonderful about the LC as well, it's the same set of documents that you're sending with cash against documents. And now if you transition to an LC and now you're offering your foreign buyer access to a lower cost of funds, wow, they'd be running to the bank and you're getting paid sooner than product even arrives. So it's just amazing that, yes, our almond industry, our tree nuts have been paid for the most part on these cash against documents. And another risk is, because we've worked with these clients as well, they'll fly over to the other country, knock on the door of the bank, and that foreign bank will say, hey, we don't know you. You're not a client of the bank. They can't let you in. They don't know you. You don't have an account with that bank. So it's just a lot of risk you're putting on a foreign bank to orchestrate your payment first and then releasing your product to the foreign buyer, their client. I mean, in reality, that's what it is.
All right. Well, we have about 3 minutes left. So Jeff, thank you for introducing the GSM 102 program. And do you have any last words of wisdom? Maybe how USDA has been working with some other specialty crop exporters on some of their shipments overseas?
Well, again, I would just say thanks for inviting me to participate. And we are always certainly open to working with exporters who are interested in the program. So if you have additional questions, or if this program seems to be of interest to you and want to learn more and potentially get started, you can feel free to reach out to me, and we're happy to walk you through the steps of getting registered. But we're always trying to reach out to new clients and do new business. So we're always here and happy to help, and want to make sure people know about these programs.
Well, Jeff, we're hoping to boost our shipments into some of those higher risk developing countries like, Pakistan, Turkey, Bangladesh, Algeria, Morocco, Tunisia. There are a lot of interesting markets out there that show a lot of potential, but there's still a lot of risk that our companies have to take on when they go into those markets. So, Joe, do you have any final words for us? Any final words of wisdom?
Yeah, thank you for letting me be part of it. You'll find on the XM1 site much of this information is public. If Exim isn't going to guarantee the country, should you do it? Should you do the sale? You know how difficult Argentina is, right? That's changing because they have new government, but they can't, right now, everybody's off cover, right?
Yeah.
So pay attention. You can get this information. You can call myself or James. We do this every day, and we can help you with any question you have because the downside is tremendous. So we're happy to help.
All right. Lisa, do you have any closing remarks?
Yeah, basically the same thing here. We're happy to help you with any of your export needs, whether it's under the GSM program or any other type of payment. If you just have questions, just reach out. We're happy to help you.
Okay, James.
No, very much what's been said. Thank you, everyone. And like I say, do reach out if there are any questions around credit insurance. It is a fairly niche line of insurance that requires a sort of constant monitoring through. I wish you could just buy it, file it, and revisit it 12 months when the renewal comes around, but sadly that doesn't. So yeah, thank you and happy to help as I.
All right. And finally, Danielle.
Thank you. Thank you for the opportunity, and please lean on all of us as your network and experts. We're here to help you.
All right. Well, it's looks like we just hit the last minute here and don't see any more comments, but I want to thank the panel again for your time and all of your expertise and knowledge that you shared with us today, and hopefully our companies will be able to take advantage of some of these new tools that they've heard about today. So we recorded this, so if some of the audience would like to have a recording, we can provide a link later on. And Taylor, is there anything at all that we need to cover here at the end?
Yeah, last thing, all attendees will get an email here shortly when the video is posted, and then you'll get a second email from me as well, which will have copies of the presentations and contact information for our speakers. So,
Thank you.
All right. Okay. Well, thank you very much, everyone. Take care.
Have a good day. Bye.